Hi, everyone. This is Josh Nelson from Keystone Financial Services. Welcome to Forecast 2019 webinar. We'll be starting here in a few minutes. I can see people are starting to dial in, and I appreciate everybody's time today, of course. It's a beautiful day here in Colorado, and we've got some people dialing in from around the country. We've got about 15% of our clients live other places now. We probably met here in Colorado, and then they moved other places, or maybe they're snowbirds and they're traveling for the winter. So thank you for not just you local people, but also people all over the country for dialing in today. So we'll give people a few minutes here, and we'll start right at 12:30. I think the important part about these as well is that we do record the webinars. That way people that aren't able to attend can watch it at a different time, maybe that evening. And in fact, usually we end up having more people view the recorded version than view the live version. So it'll be interesting to see this time around what ends up happening. A couple of housekeeping items as we come up on 12:30 Mountain Time. I've got a couple of tools in here. One of those is the chat feature. One of those is the questions feature. Keep those in mind that if you've got questions, you can type it into the questions box, and I will answer those along the way. Of course, for time purposes, I may not be able to answer them until the end, so we'll certainly get all of them answered, but we do want to be respectful of people's time that are on a tight schedule, need to get on to their next meeting at work or something like that. So we will go no longer than 1 hour total. My presentation itself will be a little bit shorter than that, so we offer up time for questions that people can participate in. Also, there's a chat feature, so if somebody could help me out and type something in there, that would be great. So the chat feature, the questions feature, if you guys could just say hi, Josh, or something like that, that would be great. That way I know that you can interact with me along the way. And it helps me out too if there's something goofy that happens, like you can't see my screen or you can't hear me or something like that. So we'll give it a couple more minutes and we'll get started. So this is our fourth version of the presentation of Forecast 2019. I gave two of them live, one in Fort Collins, one in Loveland, and then one in webinar version last week. And gotten lots of good questions from people. A lot more interest, I think, this year than most, just because of all the volatility. All right. Yeah. Thanks, Alan and John, both. Thank you. I see your questions there in the questions box. So feel free to compile those along the way. In other words, if you guys think of questions, feel free just to type them in as we go, and I'll either catch them as we go or I'll answer them at the end. Yeah, we'll give people just another minute here and we'll get started. Hi, Judy. Just saw Judy dial in. Again, make sure that you guys can use the questions feature and the chat feature along the way, excuse me, so we can interact throughout the presentation. All right. Okay, so it's 12:30 right now. We'll get started right away. Always want to start on time because I know how packed people's schedules are. My schedule is packed too, believe me. So we're all kind of in the same boat that we've got lots of stuff going on. I'd say that's the one thing that all of my clients have in common, and I do too, right? We're all in the same boat, is that we're very, very scarce for time. And that's why people hire me, I think, to a large extent, is they know that it's really important. They know that somebody needs to be watching their stuff. And of course, if we had all the time in the world, we would do that ourselves, right? But in a lot of cases, we don't. So we'll get started on Forecast 2019. Again, this is a recorded version, or this is being recorded, actually, because we always want to provide that to people who can't make the live presentation, because in a lot of cases, people are tied up throughout the day and they need to get on to other meetings or something. So we do have a lot of people that watch the recorded version. And you can see me right now on the webcam. I like to interact a little bit at the beginning and the end, but I'll take my face away as we go through the actual presentation. But I mentioned before that this particular presentation, I think, is more suitable for now than ever, simply because we had so much volatility last year in 2018. I think a lot more people are anxious right now and wondering what to do, and at least they want to get educated. And that was one thing that I decided really early in my career as a financial planner. Yeah, I started in '99, actually, so I guess we're almost, I think within a couple months, actually. I've been doing this for 20 years. Holy cow, didn't even think of that until now. But 20 years ago, that was one thing that I started right off the bat. Is I knew that that was really important, that people were educated regarding their finances. In other words, I don't think it's a good thing when people just make decisions blindly, or if they just hand over control of all their money and they don't understand what's going on. That's not a good thing. I think people make much better decisions when it's a collaborative effort, and when people are educated and understand the issues and the factors that come into play. People can make a lot better decision and are much less likely to make an emotional decision regarding their money, which, as we'll talk about in a bit, that rarely works well. You know, people say, well, go with your gut. Sometimes going with your gut makes sense, but in a lot of cases, when it comes to finance, going with your gut oftentimes will lead you in the wrong direction. So we'll go through a lot of that today, clearly, because we can see some very, very good examples over the last 12 months of both extremes, both on the greed end and the fear end. So with that, I'm going to go ahead and switch off my webcam for right now, but you should be able to see the Forecast 2019 screen. And the one thing that I also want to point out is that I put a handout in the handouts feature, and that is fresh off the press, the Keystone Financial Data 2019 card. And I see Julie's dialed in as an attendee here. That's great. So one thing that I think our tax professionals always enjoy is having that as an easy reference as well. But if you'd like to have a copy of that, a hard copy of that, I certainly can get that out to you. It's a PDF format that's in the handouts. So if you're finding that in there, that is yours as a gift from me. And hopefully it'll lead to better decision making in 2019, because it has a lot of, as it's called, key financial data. That's what it is, right? Is the key financial data around taxes and Medicare and Social Security, retirement contributions, all kinds of stuff that you might need to refer to throughout the year. And we put that out every year as an educational piece, both for our clients and our financial professionals that we interact with. So with that being said, let's get started on the actual presentation itself. Again, I know people's time is valuable, so I want to make sure that we keep moving along, but please use the questions feature along the way if you think of something that you'd like to ask. All right, so the return to volatility. You can see I basically named my whole presentation off of volatility because that's what we experienced in 2018. So my name is Josh Nelson. I'm a financial planner, a certified financial planner, big difference there, based here at Level, Colorado. Many of you know who I am. I've been an advisor now for 20 years. And a certified financial planner means that it's somebody who's not just dealing with investments, but all areas of finance, whether it be estate planning, income taxes, retirement income planning, Medicare, all kinds of different stuff that would come up when it comes to planning your future financially. So a certified financial planner does that. We do provide comprehensive planning to our clients, as well as full service wealth management, meaning we manage all the investments and help people make good choices with their money. So that being said, you can see my contact info, which I'll have at the end as well. If there's a question that comes up along the way, or maybe something that's kind of personal to you that you don't want to share with the group, feel free to just shoot me an email or shoot a call to me. I usually am pretty accessible, unless I'm on vacation or something like that. I'll usually get back to you really quick. All right. So that being said, we also have a team. Myself, I'm a certified financial planner. Renee is a registered paraplanner. She's our managing director. Sarah Bjork, our wealth plan administrator, helps a lot with our financial planning and helps our clients with the technology end of their financial plans. Jeremy Bush, also a licensed financial advisor. We stole him from another firm here about a year and a half ago or so, and he's been awesome. And then we've got two interns, Jared and Sarah. On the right-hand side there, you can see that we actually do have a strong program and a strong affiliation with Colorado State University. They have a great finance program and specifically a great financial planning program. So we do enjoy having our interns that not only are they able to get some experience and position them really well for the workforce, but also they've been able to help us out a lot along the way. And then Gail Perkins, our Director of First Impressions. She's usually the person you talk to when you call on the phone or when you walk in the door. All right, this is what the attorneys wrote. Be quick. All right, here we go. So we're going to talk about where we've been, where we are, where we may be going. That's our agenda today. And we're going to do a flyover and cover a lot of information. So I do apologize for that, but we do want to make sure that the people are well educated. But before we do that, we always like to warm up our brains, especially at least in Colorado right now. It's right after lunch, so this is kind of the afternoon lull, right? But the first question I have for you is, how long is the perfect book? And if you'd like to use the chat feature, you can give your guesses if you'd like. But how long is the perfect book? So my initial guess was something short, but the reality is the perfect book is 1,000 pages or more. That actually had the highest ratings out there for people as they did studies on people's preferences with regard to books. And the reason why is that people felt like if I'm going to read a book this long, I've got to kind of justify the fact that I made that investment of time, right? All right, let's try another one. So which country snores the most? Luxembourg, United States, China, or Brazil? Luxembourg, United States, China, or Brazil? And the answer is Luxembourg. Believe it or not, people in Luxembourg snore an average of 23 minutes a night, and also Greece and Spain, so we could have put them in here as well, but those are the countries that have the longest snoring. And it's interesting, actually, the graph too shows by age how we tend to change over time as far as our snoring. All right, this is really interesting. I have not done the research on this, but it's a real thing. So which of these is not a real business? Which of these is not a real business? So that Pep Beverage Brewery in the Colorado Rockies, of course, we brew more beer than any state in the union. A spa for guinea pigs in the English countryside, a hang gliding tour for dogs in Patagonia, or a 5-star hotel for cats in Kuala Lumpur, Malaysia. And so 3 of these are real. Only one of these is not real. Any guesses? Any guesses? I'm watching for the questions or chat. See if you have any thoughts. Got a number 1, Pet Beverage Brewery in the Rockies. I haven't been there, at least. I don't know if it's there or not. We'll see. All right. So the answer is no hang gliding. No hang gliding for dogs in Patagonia. Jim got that one right. Good job, Jim. But I got to check that out, right? We've got 2 guinea pigs and we've got a dog, and so that Pet Beverage Brewery could come in handy. Maybe we'll have to make a big trip and go to the spa for guinea pigs. And then finally, what activity burns the most calories? Mowing the lawn, golf, grocery shopping, or sledding? Mowing the lawn, golf, grocery shopping, or sledding? Got a guess for grocery shopping? Any other guesses? Yeah, I've got one for sledding. And the answer is sledding. And that's because you have to walk back up the hill, right? Normally, if there was some fancy resort, maybe there is some place where you can get a lift back up to the top, but I haven't found it. All right, so let's talk about where we've been. And it's been a wild ride, believe me. For those of you who have been paying attention to your statements or the market, you're going to see a lot of volatility in those statements unless you were just extremely conservative with your investments over the past year. It was pretty volatile, and that was really the worst of it was in December for U.S. stocks, at least. That was where we saw the most volatility. So you see what we did here is we plotted all the days the market was open during the month of December, and then you can see the swings back and forth. There's a lot of volatility and clearly a lot more red than blue, and it was shocking, really, that we had the worst Christmas Eve ever in the U.S. stock market, down almost 3% that day. And I was actually in the Midwest at the time, was back visiting family for Christmas. And tell you what, for a financial advisor, that's kind of the one market day of the year that you can count on that you could just kind of check it in and not have to worry about what's going on. But that broke all the exceptions, right? We saw a big drop that day. And the day after Christmas, December 26th, we saw a huge rally. We made up for it, right? But still, it's disconcerting to see those types of drops in portfolios, especially when it doesn't really match up with what we're hearing in the news as far as economic data. And the reason why it feels particularly bad, I think, is just because 2017 was really calm. We really didn't see a lot of down days. When you look at the charts back to 2006, with the black being the average back to 1928. You can see 2018 was actually more of an average year as opposed to some anomaly. But 2017, that was really off the charts on the downside in that we hardly saw any days where the market moved by 1% or more. Very, very small number. So really interesting, I think, in that not only the fact that we saw a lot of volatility, but the fact that it's normal. A lot of people don't realize that the swings that we saw in 2018 were more indicative of historical averages. So when we look at the two, when we look at 2017 compared to 2018, you can see the Dow, the NASDAQ, and the S&P. And sometimes I get questions about this as far as, well, what market should I watch? What should I be paying attention to on the nightly news? Well, first of all, maybe you shouldn't be watching the nightly news, right? Because a lot of it's just negative news, and hopefully we're consuming a lot of uplifting stuff as well. But as far as the nightly news or the newspaper, what I would pay attention to, even though it's not as sexy, pay attention to the S&P 500. If you want to look at what the U.S. market is doing. The reason why I say that is that the Dow is only 30 stocks. The Dow Jones Industrial Average is only 30 stocks, 2 companies from each industry. And that means that because they're equally weighted, it's an equally weighted index, that means that there can be huge swings just because of one company. Versus the S&P 500 is spread out among the 500 biggest companies, and it's weighted towards the largest companies. So think of the top names like Apple and Exxon. Those would be examples of companies that would have the biggest impact on the movement of the S&P 500. Clearly, that's going to wash out a lot of the anomalies that could happen based off of one company having a really bad day. And then the other thing to recognize about last year is that sectors, there really wasn't much that actually went up. Healthcare and utilities basically were the only 2 sectors that there were any measurable gains. So it's one of those years where you really can't do anything right as an investor. 2017 was a year where you really can't do anything wrong. You could have just used the dartboard approach, and it would have been kind of hard not to make money, in other words. But 2018, the same was true on the downside, that it was really, really difficult to make money in 2018 with every sector going down in value with the exception of healthcare and utilities. It was tough for other asset classes too, so it wasn't just U.S. stocks. In fact, non-U.S. stocks, were much worse. We saw 2017 as the blue, 2018 as the red. You can see that obviously a huge, huge change between the 2 years. Really, it was pretty tough to make money, again, in any area. The only area that you actually could have seen some gain would have been in treasuries, believe it or not, with extremely low yields right now, but you still would have seen some gain in 2018. And then the global markets weren't any better. International markets all sold off, with the exception of Qatar. If we had invested in Qatar, which we didn't, unfortunately, but if we had invested in Qatar, we would have seen some big gains. Obviously, a very small, illiquid market, so that's why we don't invest in places like that. Or if we do, it might just be in a very, very small way. The majority of our clients' investments are going to be globally diversified, which means that we're not going to put a huge concentration in any one company, especially in emerging markets, which most of the countries on here would be considered an emerging market. Even Greece, which is a really, really old country, of course, but it's more of an emerging market just because their economy is not stable and has had a lot of problems over the last 10 years. So some pretty severe losses in many markets makes the U.S. look not so bad, being down only 5% for the year. What makes it look even worse, though, is the fact that we had seen some gains. I think that's why a lot of people think that we lost so much, is because we were seeing statements throughout the middle part and up to the end of Q3 as far as gains, and then all of a sudden all those were given back plus some. So we saw a negative 5% number at the end of the year. So like I said before, the unusual part about this is the fact that most of the economic news has actually been quite positive. If you look at the different factors that go into what I would say, kind of look at the mixing bowl of financial information or economic information that you would kind of throw this stuff into and say, this would lead to a good recipe or a bad recipe for some outcome. Well, if you look at the different factors, one of the major ones would be corporate earnings. And corporate earnings were off the charts in 2018. Now, some people will tell me, they'll say, you know what, isn't that just artificial? Isn't that just because of the tax cuts that were passed the year before, which reduced the corporate tax rate from 35% down to 21% for U.S. companies, for U.S. corporations. Wasn't that the reason for these big increases in earnings? Only partially. So that accounts for about half of that number. When you look at the Q1, Q2, Q3, 2018, Q4 was good as well, by the way. We just didn't have the data out when we created the slides. But you look at all three of those numbers, and you can see that about half of those earnings were attributed to the tax cuts, meaning that at 12.5% earnings growth is still pretty darn good. And that's actually above historical average. So it means that companies actually are profitable in spite of the tax cuts. We still would have been doing well, in other words, as far as growth, had we not had the tax cuts. So 78% of the companies in the index in the S&P 500 reported earnings that exceeded estimates. And obviously, there's all kinds of different thoughts on that as far as companies that sandbag, and so they end up having always these great earnings reports. But the reality is those numbers are tracked over time, and as a trend, that's a very, very good number as far as companies that are exceeding their estimates. So I like quotes. One of them is to say that earnings have been anything other than stellar of late is to misrepresent what's happening in corporate America. But the stock market obviously has, at least in December, had been expressing concerns of a downturn. Now, since then, of course, we're giving this in mid-February. So since then, we've actually seen a lot more economic reporting has come out. Of course, pretty much every day, some piece of economic information ends up coming out, and it helps us get a better picture of where we are and where we're going to be. But I can tell you that the numbers that have come out since the first of the year actually have been quite positive, and that's to a large extent why the market's been rallying, because I think stocks are more and more discounting that there's not likely to be a recession this year, maybe not even in 2020, but it would be extremely unlikely this year. So again, this big mismatch where we've had great earnings, yet we saw prices drop. Didn't really make sense temporarily, but those are the opportunities. Those are the opportunities that present buying opportunities, because a correction, by definition, a correction in the market is a negative 10% or more. And a bear market really doesn't happen unless we're in a recession. A true bear market, in other words, would happen in a recession, and typically would be down 20% or more. So the reality is this was probably just a correction, fairly run-of-the-mill event, and it did make stocks cheap. And again, the buying opportunity is buying things when they're cheap. So if you look at some of the best investors of all time, Warren Buffett, for example, is a classic value investor. We'll talk about value investing later, but a value investor, basically they wait, the classic value investor would basically wait until there's metaphorical blood in the streets, in other words, where things are really, really ugly. And Warren Buffett made out like a king after the financial crisis because he was the guy who had all the cash, and there was a lot of companies that needed cash, and he was able to negotiate some wonderful deals for Berkshire Hathaway during that time period. But had the fact that he had the cash, and that's why it's so important to understand your time horizons and your risk tolerance, your portfolio. That's just critical, because we need to know when we're going to need the money. If the stock market is way down and we need the money, it doesn't help that somebody tells you, well, stocks are cheap, it's a good buying opportunity, right? That doesn't help. For somebody who's still working and maybe has a long time horizon until they need that money, that's such a bad thing, because you're probably still buying. You're probably still contributing to your 401k or some other retirement plan and buying while prices are cheap. So you can see on my chart here, this gets a little bit wonky, in financial land. We enjoy stuff like this, but the point though is those dotted lines are looking at the historical price to earnings ratio of the S&P 500. So what that means essentially is that if you just looked at prices, then you have nothing to compare against. So, for example, we would actually end up just looking at prices and saying, hey, the S&P of the Dow is at an all-time high. And a lot of times people would get triggered by fear at that point and say, well, that means it has to drop, right? Only if you don't compare it against earnings, because if you just look at that one factor, it's not very useful. We compare prices with earnings, and that's the only reason a company is worth anything is its earnings. So, and by the way, only 4% of companies make it 10 years from their inception. So it's exceedingly rare that any business ends up making it. So, and a lot of companies, even after they've been going for a number of years, if they don't stay current, if they don't stay competitive, obviously they can go down really quick, and we can obviously give a lot of examples of that. So earnings are the only reason a company is worth anything. Their profits, in other words, means the same thing, earnings, profits. But if we compare prices to earnings, we're right about historical averages right now. You can see the data actually is into 2018. We can see the bounce actually is starting, and prices aren't as attractive now because we've seen a good rally since the first of the year. But nonetheless, we're not at crazy levels. We're not at crazy valuations because earnings have gone up so fast. They've gone up so much faster than prices that we have good values as we're buying into the market. So Treasury yields moved lower later in the year, and there were a number of reasons for that. But obviously, if you're borrowing, that's a good thing because it means that your mortgage rate is probably lower than you would have gotten 6 months ago. So that actually helps the economy in a lot of ways. First of all, the consumer is the driver of the economy. 70% of our economy in the U.S. is driven by consumer spending. In other words, just you and I spending money on stuff. And the reality is if we don't have cash, if we don't have jobs, then we're not buying stuff, and that's going to lead to a bad economy very quickly. Good example is look at the financial crisis. Mass layoffs around that time frame. So a lot of people losing jobs, unemployment rate was going up dramatically, and the consumer stopped spending, basically out of fear and out of not having the cash that they traditionally would have had from people working. So all of a sudden we had GM, Chrysler went broke almost overnight, it seemed like anyway. We had insurance companies that were going broke, banks that were going broke. There are a lot more reasons for that. Obviously, we can go through and do a whole presentation on the financial crisis, but nonetheless, it ended up being pretty tough because the consumer didn't have cash. You had a 30% then is government spending and business spending. So interest rates are still low, and this is the quote, by the way, from the Fed chair in late November. This is the quote that kind of set off a lot of selling that happened in December, because what the market doesn't tend to like is a lot of interest rate increases, because that tends to put a buffer on earnings, on profits, because consumers don't have as much money in their pockets if they're paying higher interest. Businesses are also having to borrow at higher rates. The government even is having to borrow at higher rates because a lot of our spending is funded by debt, like it or not, right? We can get into a whole debate about that, but the government even could be paying higher interest rates on their borrowing. So if interest rates go up dramatically, that can really be a tax on the economy and can send us into a recession very quickly. And in fact, many past recessions were triggered by the Fed being overly aggressive. The reason why the Fed gets overly aggressive is they don't want hyperinflation. They don't want out of control increases in prices. But really at this point, the Fed was feeling good enough, at least as of late November, to kind of forecast that, hey, we're going to continue on this trend in 2019. We're going to continue with 3, if not 4, quarter-point rate increases, and the market really didn't like that. The market really reacted badly to that in December, and since then, the Fed has backed off of those statements and now is saying that they'll be much more measured, much more accommodative, meaning that we probably will see some rate increases this year, but it probably is not 3 to 4 unless inflation just takes off like crazy. Who knows? We may not see any rate increases. That would be unlikely. I think we'll see 1 or 2. And one other factor, sometimes people pay attention to the yield curve. And if I asked you to borrow some money right now, if I wanted to borrow money and I said that I would pay you back next week, and then I borrowed from somebody else and said, I'll pay you back next year, and somebody else, I'll pay you back in 10 years, unless you're just doing it out of the kindness of your heart, the person that I'm borrowing from for 10 years is probably going to charge me a higher interest rate than the person that I'm borrowing the money for 1 week. And that basically is how interest rates tend to work. When there's an inverted yield curve, what that means is that there's a lot of uncertainty in the market that's been created. And in fact, sometimes a yield curve inversion actually leads to, is actually a forecast of a recession. The trick is it's sometimes, not always. And in fact, the yield curve now is more normalized as of today. So this is kind of an extreme example, obviously, but an inverted yield curve basically means that interest rates get lower as the securities are further and further out, which makes no sense. But again, that's why the forecast usually in a big inverted situation is that inflation is going to be lower in the future, which could mean that the economy has slowed way down. Could be the short-term yields will be lower in the future. It also could be that people were flooding into bonds. It could be just a safety thing that a lot of people are buying bonds. And I think that's what was happening in December, not necessarily that we're on the verge of a recession. So where we are now, and again, I like to throw some fun stuff in here just to wake us up. One of the things that I think is interesting is selfies. And you can see here that there's a wide variety of opinions here on what's acceptable and what's not when it comes to selfies. But different age groups also have different acceptance levels. So most people, on the younger end especially, say it's okay to take a selfie at a concert or while visiting a tourist site. But at the end there, you say, well, attending a funeral or while in the bath, I can't believe anybody said that they would find that acceptable. But obviously somebody did. So go figure. So we're in an expansion. We still are in expansion. It didn't feel like it in December, but the economy is still in an expansion. This is another thing that I've heard a lot of people worried about, is that this is on record the second, and it will be eventually. I don't think the economy is going to slow down this quickly. So we're probably going to be in the longest expansion ever here from 2009 on, because 2009 is when the economy came out of recession technically, and we've been in an expansion ever since. So the one thing that people tend to get anxious about then is that, well, if this is the longest expansion ever, don't we have to see this big drop on the other end, or are we in a bubble? Is something overexpanding, basically? And the reality is sometimes that can happen, and you can see from 91 to 01, we actually saw that still is the longest one right now. That actually was a classic bubble where things were growing too quickly. So the 90s were a very good time for the economy in general. So the one thing I will point out is that the last 10 years, most of it, we were not seeing rapid growth. We weren't in a recession, but we were growing really, really slowly, just barely above a recession, just barely above flat, in other words. So one thing to keep in mind is that if I were to go outside right now and jog around versus run around, I could jog a lot further than I could run. And that's basically the same thing with the economy, is that it was really a slow growth period. So it actually gives us a longer period of time before really we need to go into a recession. That's kind of a weird concept as far as needing to go into a recession, but we need to go into recessions just like we need to go into expansions. It's just like we need to go into winter and we need to go into summer, because economically that's just part of the ecosystem. The fact that there tend to be excesses in certain areas, or maybe overall, and those excesses need to get taken care of, and those get taken care of in a recession where a lot of stuff dies, kind of like winter time. So in winter time, a lot of stuff ends up dying. The leaves fall off the trees. The harvest happens right before that, right? So I think that's where we are. That's where we are, is in the fall right now, when we're harvesting a lot of gains. We're seeing a lot of economic growth, but eventually that starts to break down. Eventually fall starts to break down and turns into winter. That's where we're going economically. There's debate about when that'll happen. How quick will it happen? And that was why the market reacted so poorly to the Fed, their uncertainty and their aggressiveness, basically, in saying that rate increases are going to continue, even though some are actually seeing some signs that fall could be moving towards its later stages. So people don't like losing money, and that's why we saw December, basically. People tend to overestimate how much risk they're willing to take or how much money they're willing to lose. And then when they lose it, they tend to do rash things. It kind of came back to what we said before as far as not reacting emotionally with our money, with our investments, especially when we're in a really high state of emotion, which would be when people are feeling really, really confident or really, really greedy in some cases, versus being really, really fearful on the bottom end. People tend to do some crazy stuff like sell out when the market's really low and buy in when the market's really high. And a good example of that, you can see my graphic here with coins. Remember Bitcoin? Yeah, people aren't talking about Bitcoin very much right now. The reason why is that at one point it got up to 20,000, and now it's down in the low, 3,000, something like that. Last time I looked, again, it's not something I track very often, but Bitcoin was this big mania and a lot of greed driven. A lot of money came in at the end, basically at the top when it got up to 17, 18, 19,000. And then, of course, after all the losses were experienced, after a lot of money was lost, then people wanted to sell out. So a classic example would be Bitcoin. Another great example would be the dot-coms of the late 90s, most of which never earned a profit, most of which don't exist anymore. And the interesting thing is that a lot of times people think, well, but that's kind of the future. You have to invest in the future. But one thing to keep in mind is that the pioneers are the ones that take the arrows, right? It's the first ones that actually get the most pain, and most of them don't make it. And then when it comes down to the followers, or the ones that figure it out, are the ones that actually figure out how to turn it into a business model that's sustainable. So Bitcoin isn't going anywhere. Cryptocurrency isn't going anywhere. Most cryptocurrencies, people have lost massive amounts of money putting money into those things, but that doesn't mean that they're going away. In fact, the technology, the blockchain technology that's come out of the development of these cryptocurrencies has actually had a lot of application at big companies like IBM. So just because most of the money will get lost doesn't mean it's a bad concept. The other thing is .coms. Clearly, .coms didn't go away, right? We still have the internet. We still have websites. We still have certain companies like Amazon, certainly, or eBay that made it, and they figured out how to turn it into a legitimate, profitable business model. But keep in mind that whenever there's some kind of a new fad, the other one I'm hearing a lot about right now is people saying, well, can I invest in marijuana stocks, or can I invest in things related to that industry? And the truth is, yeah, you can, but most of those companies won't make it. Most of those companies will end up going down because there's too many, right? There's too many that flood in, and only a few actually will end up being the ones that can survive and actually figure out how to make it a business model. So the good news about the market and losing money is that we make a lot more money than we lose. This is probably one of my favorite charts that I've placed into the presentation, because it shows you as severe as the financial crisis was over there. You can see in 2009, 2008, we saw a 50% drop in the stock market during that year. So it was a massive, massive drop we saw in a very short amount of time. And it was scary. It was scary. Even to people like me that are in the financial industry and are supposed to have more iron stomachs, we were scared too, right? We didn't know what was going to happen. Same thing in the dot-com crash. We saw almost a 50% drop in the market during that period of time. So it's no doubt about it. It's not comfortable, and it is scary. Kind of like if you're in an airplane and you get into some extreme turbulence, it's not comfortable. It doesn't matter how often you fly, it's still not comfortable. When it gets really uncomfortable for the pilot, even, sometimes that happens, and obviously you just have to get through it. Rarely do planes crash because of turbulence. It's extremely rare. But the reality is that's part of the ride. And when we get into bull markets, of course, we're enjoying the gains from that. And that's what we've been seeing over the last decade or so, is some pretty large upside. Eventually, will we have another bear market? Yes, of course. Will we have another recession? Yes, it's coming. We don't know when. That's the real trick, is knowing when. It's very, very seldom that an economist can accurately predict when a recession is going to happen, or a market strategist guessing exactly right when the market's going to drop. So where we are in the business cycle, you heard my metaphor before about seasons of the year. And this is kind of like my chart here as far as an economic growth period versus a contraction or a recession. You can see, based off of different countries in the world, clearly China is not in a technical recession. In other words, they're still at a positive growth rate, but at 6.6% growth, that feels like a recession to them. Believe me, in China right now, they're not thrilled with their economic performance. So after decades of being up in double-digit growth, now they're down to 6.6, and it definitely feels like a recession. So lots of reasons for that. We won't unpack that right now, but clearly part of that is the trade war that the U.S. has had with China over the past year. So you can see where the U.S. is that we're still in an expansion. Clearly, I think there's not many economists that would say that we're not in an expansion, because the data clearly points to that. When you look at GDP growth, unemployment, interest rates, inflation, we're clearly in an expansion, but we are moving through it. So over the next year, maybe 2 years, we might have some time left here until things really slow down. But really, from the biggest economic growth we saw was up in the threes last year. Now we're down about 2.5 or so. And that's still not a bad growth rate. That's about the historical average for the U.S. But clearly, we're going to continue to slow as we move throughout fall and move towards winter. So again, it's very hard to predict financial crises, economic crises. In fact, statistically, about 10 to 12% of the time, we're in a recession. Economies are in a recession 10 to 12% of the time. So the good news is the other 90% of the time, we're not, right? That means we're in an expansion. Things are growing. That means our assets are growing too, our real estate or stocks, things like that. But what's really, really rare, again, is to be able to forecast a recession. It's very difficult to do that. Even the smartest economists think you're Ben Bernanke, people like that seemingly have all the information. And it is true, they do have all the information that's available, but there's too much information. Maybe there'll be some artificial intelligence someday that can actually predict a recession, but we have not seen that yet. And a lot of that is because of uncertainty and unexpected stuff that can happen. You can see I've placed this chart on my presentations in the past. And of course, these are all kind of the major issues of the world, right? As far as trade relations with China and, of course, strife in the Middle East, which has always been for thousands of years, always probably will be. Global trade tensions, Russia getting into conflict with NATO. These are all things that may or may not happen, of course, but any of these things happening or uncertainty around these areas in particular can result in a lot of market volatility. So keep an eye out for them. Obviously, you can't predict a major cyber attack. You can't predict most of these geopolitical events. A lot of times, even one that somebody predicts correctly, they may predict that it happens, but they may not predict how it's going to play out. And in some cases, it actually ends up being a positive for certain markets or economies. My chart didn't come up there. See if we can make it go. No, that one's not going to behave. Wonder what happened. Yeah, so but late in 2018, investors' attitude shifted dramatically. What you don't see on here is you don't see that we went from bullish to bearish, and the reason why I've got a bar chart basically that kind of shows that economy might go from, or that investors may go from bullish to bearish in a very short amount of time, and that's what basically happened. In that we had investors start out in early 2018 very, very bullish. And then we saw February happen and March happen, which were really bad months. All the gains were given up. And then we saw the rest of the year up until at least the end of the third quarter, people were pretty bullish and making a lot of money. And then, of course, very bearish in the fourth quarter. The reason why I include that in the presentation is, again, back to emotions. And if you look at the average investor over the last 20, 30 years, the average investor in the stock market's averaged about 10%, give or take, a little bit north of that. But numerous studies have shown that the average investor gets less than half of that return. And we're not talking about a different market. We're talking about the same stock market, but the average investor gets a less than half of the total return for the market. They do less than half of that. You might say, well, it's because they invested in other stuff and bonds or things like that. No, I'm talking about stocks only right now. So just being a diversified stock investor, the real difference is that the average investor buys high and they sell low. And as we're sitting here, you think, that didn't sound right. What are you talking about? Why would people do that? But the reality is, we talked about Bitcoin before, right? And that when did people want to buy? They wanted to buy after their neighbor made a bunch of money or after they heard it in the news. That's when people didn't want to miss out, right? And so they wanted to put money into that asset class. But then, of course, it did reach a peak and has come down over 70% in value at this point. And so do people want to buy now? No, they all want to sell. They all want to sell out those assets, which makes no sense. It would kind of be like if you had your house on the market and then the market dropped in half. Unless you had to sell it, you wouldn't sell it. You just take it off the market and say, no, I'm not going to buy. And in fact, if you had extra cash in a market like that, you probably would say, I'm going to go buy some rental properties. I'm going to go buy some stuff that I can buy from the banks because of things in foreclosure. I saw a lot of people do that 10 years ago when we were in the financial crisis. Again, people like Buffett that had the cash, had the capability of buying stuff when it was cheap. So just instructive in that you don't want to be that person. You don't want to be the person. You can see my source. It's really small down in the bottom there, the American Association of Individual Investors. That was the source. So if you want to do the opposite of any group of people, do the opposite of the American Association of Individual Investors, because the average investor does exactly the opposite of what they should be doing. in the fact that they're selling when they should be buying and buying when they should be selling. In fact, there was a good Buffett quote, not Jimmy Buffett, but Warren Buffett. Do you want to buy when people are fearful, and you want to sell when people are greedy? So that's what you should be looking out for, is especially extremes where you find extreme greed. Not a bad time to take some risk off the table. When you see extreme fear, not a bad time to put some more risk on the table. The key is not to try to time the market, but to be aware. I think to be situationally aware of the type of economy or market that we're in. So finally, where we may be going, learning to align money and happiness. Now, I think it's important. I know this is about the market. It's about the economy today. But one thing that I think is really important is to remember what this money is for in the first place. And the reality is the only reason to invest in anything is for income. Unless we are just speculating, the only reason to invest in anything is for income, either income now or income in the future, either for you or for somebody else. So if you think about that, if you bought a rental property, I'm not saying go out and buy a rental property, but if you bought a rental property, why do people invest in those? Invest in them because they want the income, right? They want the rent. They don't want to just let it sit there empty. It would be a terrible investment if they let it sit there empty. So they want to rent it out. They want to get that rental income and maybe tax advantaged income at that. So the same thing is true, of course, of a CD, of a bond. They pay interest, right? That's the only reason to invest in it, because you get money back. Why would you invest in a company? Because you get profits. Why would you invest in a stock? Because they're profitable and you want to make money because of the dividends and it going up in price because those profits have gone up. That's the only reason to invest in anything financially. But that being said, it's important to remember why in the first place. What are you going to use that money for? And the reality is, if we dig deep and really think about what do we want to use that money for, it's to be able to help other people. It's to be able to impact other people's lives. It's to be able to create magic moments and experiences. So that's the only reason to be able to, that we want to accumulate this stuff, right? Nobody dies and on their deathbed they are really proud and excited that they have so much money. It doesn't happen. People are thinking back to their memories. They're thinking about the experiences that they had, the people that they got to touch, their lives, the people that they were able to give to throughout that time. So just keep that in mind, that there are lots of ways to be able to do that. And of course, investing in others, either with our time or with our treasure. So with that, where we may be going. Some countries obviously will always be growing faster than others. There's always areas of the world, pockets of opportunities, even if we're in a global recession, which we're clearly not right now. But as you can see on the chart, most areas are slow growth, meaning in that 0 to 3%. That's the majority of the world right now, 0 to 3%. I mentioned China before. You can see the dark green, 6.6%. They don't feel like they're in an expansion right now. Believe me, talk to people in China, they feel like they're in a recession. So even some of those areas have certainly slowed down. But the majority of the world is growing, just growing slowly right now. Growth has started to slow a bit from what we had been this past year, but nonetheless still in an expansion. You can see the green countries are primarily emerging markets, and a lot of those areas are politically unstable. That's why we don't stick all of our clients' money in international markets, because they may be politically unstable. It could be that there are areas of the world that don't have a lot of infrastructure, so it's a lot more uncertain as far as companies' success in those areas. So it's not to say that we don't want exposure to these areas, but keep in mind, in a lot of ways, we get international exposure even if we just own a U.S.-based company that's global in nature. So figure a company like HP or Walmart or Amazon. These are all global companies. Even though they may derive a lot of their profits from the U.S., you can actually derive a lot of profits internationally as well, regardless of where that company is headquartered. So keep that in mind, that you always want to be globally diversified, but certain markets are more stable than others, and the U.S. stock market certainly continues to be the most stable market globally. You can see the same thing but plotted in percentages here. So again, China, you can see India is actually growing a little bit faster and actually accelerating. So an area to keep an eye on. Qatar, you can see there at 2.8%. So this is the rest of the world. Again, very not bad. You know, a lot of these economies, their growth rates in the 2-3% range are not necessarily bad for those markets. So the one thing to keep in mind is that stocks are cheaper internationally, and you can see the performance gap that we've already seen start to unwind and change here in 2019 is that the U.S. and international markets saw some big divergence in the last few years, where you saw the international markets really do poorly compared to the U.S. We've actually seen that reverse course so far for the year, and largely in part because international stocks just got very, very cheap. They got very attractive. So although the U.S. market is likely to continue expanding and growing, that doesn't mean you shouldn't have any international diversification, because you could get some great values and very good companies that are just headquartered outside the U.S. And then value and growth. I mentioned this before. Value stocks are stocks that are cheap. So a classic value investor would be Warren Buffett. So we use him as our poster child for value investing. And what that means is that we buy when things are cheap. We buy when companies are out of favor. And so the exact opposite right now would be a company like Apple or Amazon, growing really, really quickly. So they're great companies. They're growing very quickly. If you invest in a company like Amazon or Apple, you're paying a lot for it. You're paying a lot for their earnings. And what you're banking on, if you're buying a growth stock, because you know you're paying a premium, you're banking on the fact that this company will continue to grow and grow quickly enough that even though I may be overpaying right now, it'll still be a good investment. It'll still grow fast enough that it makes up for it. A value investor says the exact opposite. Value investor says, no, I buy stuff when it's cheap. I buy stuff when it's on sale. And if we end up seeing a situation where our stocks, a sector, an individual company gets very, very cheap, we want to take a look at them. The one thing that you do have to watch out for in value investing, because that all sounds great, right? The one thing you have to watch out for with value investing is that sometimes companies are trading at a discount for a very good reason. It's going through a problem. The company typically is going through a problem, or their sector, their part of the economy is going through a problem. So it's extremely important to be able to assess which companies are going to make their way through it and which companies are going to crash and burn, because there are plenty of companies that crash and burn, especially in recessions. That's a natural thing that happens, and it's actually a healthy thing. I know that seems weird, but it's a healthy thing to go through a recession, because it ends up getting rid of a lot of inefficiency and a lot of waste. So the one thing that I did want to point out here is that we've been in a growth market for a number of years, and sometimes people will dump their asset classes that haven't been growing as quickly, but that's a big mistake, because you still want to stay diversified. The real answer is not value or growth, it's both. The real answer to the question of should I own international stocks or U.S. stocks, the answer is both. Should I own stocks and real estate? The answer is both. So being a diversified investor means that we're always going to be buying some stuff that doesn't seem very attractive, and we're going to have some things that looks like it's really working, but those things go back and forth. If you're really diversified, it always means that you're going to have something that's not doing well, and you're going to have some investments doing very, very well. So keep that in mind. Just stay diversified, and more than ever right now, because the market is not in a bad place right now. We're still in a growth market. We're still growing economically. That's the time to make sure that we're assessing our risk and not taking on too much risk. Also, you don't want to take on too little risk, though. So that's why you need a person like me. You need a financial advisor who can help you figure it all out. You don't want to take on too little risk, because if you take on too little risk, you won't be likely to gain any kind of a return over inflation. So a couple quotes here as we start wrapping up. Good quote from Vito Racanelli from Barrons. This is in their 2019 outlook, and I think this is well said. Investors will soon bid good riddance to 2018. Of course, this was written about a month or 2 months ago, so it was a tough year. Certainly, market-wise, it was a tough year compared to what we've experienced in recent years. And then Blackrock says that we expect global growth to slow next year. So this will be 2019, that global growth starts to slow down, that earnings start to not deteriorate to the point of companies operating at losses, but the things that are going to continue to slow. So again, that just substantiates what I said before, as far as us moving closer and closer towards the middle, if not late part of fall. Now, the trick, again, is not knowing when is it going to end. When do things really start to break down? And it's not likely to happen this year. I think it would take a shock event for 2019 to actually turn into a recession this year. But 2020, 2021, obviously the odds are going to continue increasing as we get closer to those years. So something to watch out for. The economy probably will continue to grow, just not as quickly as it has been. Again, same thing with earnings, will continue to grow, just not quickly as they have been, but we're still in a growth economy and a growth market. And then finally, people hate diversification in the bull market. And you say, well, why would they? Well, it's because what we looked at before, right? And there are areas that didn't do very well the last couple of years. Even if you throw out 2018, international stocks didn't do very well compared to the U.S. Value stocks didn't do very good compared to growth stocks. So this is the time when a lot of people make some key mistakes in their portfolios, and that they want to throw out diversification and just do good, invest in the things that did good last year. Well, if you do that, then number one, you're going to be very under-diversified, and more than likely, you're probably buying the thing that's expensive right now. You're probably buying at the top for something that is going to either slow way down, right? It's going to slow way down growth-wise, or it could see some big losses in time to come. The idea is to diversify, even though it's boring, and even though it seems like we're missing out on some returns that other people are getting. Unless those people are really lucky and they get out at the right time, they're going to experience some pain on the other side of it. Then finally, my cartoon here, the stock market fell sharply today, then bounced back, spiraled upward, jumped forward, leaped to new heights, tumbled rapidly, and took first place in a gymnastics competition. That's what 2018 felt like, especially December. Definitely felt like that if you paid attention to it. Now, the real key is to not pay attention to it every day, right? And certainly not to react to it. So I do want to make sure that I educate you on that, but the media is there for one reason, and that's to sell ads. They are advertising companies. Obviously, we want them to be telling the truth. We want to be informed citizens. So it's not to say we shouldn't pay attention to any news, but keep in mind that they're there to sell ad space. And the average ratio in any kind of media is about 17 to 1. That's 17 negative news stories to one positive news story. And maybe I'm just an eternal optimist, but I don't believe that there's 17 times more bad things than good things happening in the world. I just see a lot of good stuff happening right now, but recognize where the media is coming from, and they know the bad news sells. So sad commentary maybe on society and what we like to consume as media consumers, but that's the reality. So the key on all of this is, we started a new year, and obviously we're a couple months into it right now, but we've started this new year, and it is an opportunity to get a fresh start in our portfolios. Really, really, really good timing right now because the market has erased most of the losses that happened in 2018. So it's an excellent time to reassess our risk tolerance, our portfolio. Are we diversified? Really good time to do that, because the wrong time to do that, if there is one, the wrong time to do that is when we're in some kind of a bear market, or after we figured out, I figured out I had a lot more risk in my portfolio than I really did. And gosh, now I'm down 20%, 30%, 40%. What should I do? Well, of course, it's a tough position to be in because we don't know where the bottom is in any kind of a market. But the other side of the coin is that if we sell out at that point, then we've locked in the losses and there's no way to recoup those values. So every investor is different. We don't have a one-size-fits-all portfolio. So every investor, we help you individually assess your risk and what you're comfortable with and what your plan is, what rate of return you need over time to help you determine where your money should be invested. So with that being said, I'm going to open it up for questions. I know some of you have to pop off, and that's fine if you've got to jump onto different calls, but I will field some questions if you've got them. This is our team, by the way, out on a sunny day, not right now, but out on a sunny, warm day earlier this year. So you work with a team. You don't just work with an individual when you work with Keystone. You work with me as your leader, obviously, and these guys are great participants in that, but definitely want to make sure that you know that you've got a whole team here to support you. So any questions that you've got while you're on the call, I'm not seeing any in the queue right now, but I will throw out one that I'm getting a lot these days, and that one is that how do you know when things are going to turn? How do you know when to time things, when that winter is coming economically, so I know when to shift my portfolio? So the reality is, and I know this isn't the answer that you probably want, but the answer is that you want to adjust the portfolio well ahead of that time. When things are still good, when the sun is still shining, when you're still in the fall, you want to adjust your portfolio at that time so you're at a risk level that you're comfortable with. And it should be a portfolio that you're not having to time things. You're not having to pull money in and out of the market, because that never works. There's never been an investor, consistently anyway, there's never been an investor that can consistently time the market. In fact, that's a famous Buffett quote, in that he said that he's never met, and I think he means people, but he said, I've never met a man that can time the market consistently over time, and I never have either. There's no evidence that people can do that consistently and actually have it be successful. Usually what ends up happening is they like to sell when things are low and buy when things are high, and we know that that outcome isn't good. So I'll jump back on the screen here as we wrap up. Thanks, John. John just jumped off the call. He had to jump to another meeting, but they enjoyed the seminar. Always want your feedback. If you've got topics beside this, obviously this is the market forecast presentation. But we like to do webinars throughout the year, and if you've got topics that you'd like us to talk on, or you'd like me to speak on or address, please let me know. Josh@keystonefinancial.org. And remember a couple of things. We do have the handout again that is the key financial data for 2019. Print that out or save the PDF to your computer. We also have some hard copies, a limited number of those if you'd like those. We also will be doing additional webinars throughout the spring and summer, so keep an eye out for those. Stay on our email list. You should be getting an email at least about once a week or so from us with our market commentary and our invitations to events that we do. But otherwise, hey, I appreciate your time. I appreciate your business. Certainly appreciate the faith that you put in my team and I to be able to guide you through these crazy markets. Yeah, and I think 2019 is going to end up being a good year overall. But again, winter's coming. We need to watch out for the future, not just what's happening right now. Hope you guys all have a great day, a great week. And if there's anything that I can do or my team can do to serve you better, please let us know. Take care. And again, we did record this, so if you'd like us to send this to one of your friends or have a recorded version for yourself, please let us know. We'll be sending that out. Take care. Thank you.